Hi everyone, welcome back to my channel. It's Suyin here. Today I'm going to be looking at the Syfe portfolios with you, and we're looking at which one would I actually pick to invest my money into. So this video has been highly requested for a while now, and Syfe approached me and said they wanted to collaborate, so thanks for sponsoring this video. But everything that I say is completely of my own opinion, so I hope you enjoy this video, and let's get started. So when it comes to investing in robo-advisor platforms, I tend to want to focus on the one that I most think is going to make me a lot of money over the longer period of time. And so far that's been Stashaway. And I've been very adamant on investing only in Stashaway, but something came up in the sense that Syfe has an offering that is very different from my Stashaway portfolio currently, and in particular it was their REIT Plus portfolio that I thought was so different that it warranted a look. So that is the case for this, and Syfe has 7 different portfolios, and I think that is a large number of portfolios. So what I'm going to do is get rid of the one that I think is not relevant to me, and that would be their cash portfolio. So I don't need another money market type fund, and I'm going to get rid of that. That leaves me with 6 portfolios left to contend with, and there are the core portfolios for Syfe. Within that category of core portfolios, they have core growth, core balance, and core defensive. So the differences between them are basically their allocation of the 3 types of ETFs that they have within them, which have to do with equity, bonds, or gold. So the core growth portfolio will have a higher equity allocation, whereas a core defensive portfolio will have a lower equity allocation. So we'll get more into detail for that, but I can already tell that I am more interested in the core growth portfolio, and I would probably eliminate those other 2 of balance and defensive because I have a longer time horizon for my investments, and I don't really need that bond allocation or gold allocation right now. That leads me to the next portfolio of REIT Plus. So this, I have to admit, is the portfolio that actually made me look at Syfe, because they're investing in Singaporean REITs. And by Singaporean REITs, they are very famous. You know, they have performed much better than our local Malaysian REITs, and they have a couple in there that I actually have put some money into, but I invested for my dad instead of for myself, unfortunately. Then after that, we have 2 more portfolios in that there is Equity 100, which is 100% focusing on equity ETFs, and I really like this strategy. This higher exposure is very attractive to me, and I will probably look into that further later on. After that, we have the last one, which is Global ARI. ARI stands for Automated Risk Managed Investing, and this particular portfolio is really focused on making sure that the investor is able to have that peace of mind by reducing the volatility of performance in their portfolio. So they all have this corresponding DR with their global ARI portfolios, and when you see a number tied to the DR, it's actually guaranteeing that to a certain probability, the portfolio will only drop by that number. So let's say DR25, the portfolio has a 97 point something percentage chance of dropping by 25% maximum within that year. So this kind of portfolio is actually very defensive. It's not really my style, and I can give you an example of it in working. In 2020, they have this portfolio of DR13, downside risk of 13, and what they did was they adjusted their equity ETF allocation from 50% to 10% so that they wouldn't see such huge falls in their portfolio, especially during the March period of market crash. So I'm not into that strategy of investing, so that is going straight away for me, and we are left with actually just 3 portfolios to look at. So we're going to look at these portfolios in detail. Again, what we have left is core growth, Portfolio, REIT Plus Portfolio, and Equity 100 Portfolio. So I think that makes my life simpler, and let's dig in deeper together. So first off, I have used Notion again to compile my notes from my research, and I will link my sources down below so that you can access where I got this information as well. So we're going to look at the Equity 100 Portfolio first. Syfe, I guess, prides itself in investing with the strategy of smart beta. And what smart beta is actually factor investing, where they're investing in 3 particular factors of growth investing, Chinese exposure, and low volatility of their ETFs. So I think they believe that China is going to be a huge superpower, perhaps maybe overtaking the US at some point in time in the far future, and that's why it's important to have this Chinese exposure. Something to note is that Syfe will actually re-optimize their portfolio twice a year, so you can expect that to happen, and they most recently did re-optimize as well to make way for this Chinese exposure. So for the ETFs held within Syfe's Equity 100, we can see that they have QQQ, which is the Nasdaq 100 non-financial companies, and they have CSPX, which is interesting because they have chosen an S&P 500 ETF that is domiciled in Ireland, so that the tax withholding is lower at 15% instead of the normal 30%. They also invest in RSP, which is the equal-weighted S&P 500, and they have EFA, which is large-cap, non-US, non-Canadian companies, IEMG Emerging Market, MCHI, and KWEB, that's your Chinese exposure of large and mid-sized Chinese companies, and of course the China internet companies. Then they have the US ETFs of XLP, Consumer Staples, XLV, Healthcare, XLU, Utilities, XLK, Tech, IJH, Mid Cap, and IJR, Small Cap. They also removed 2 particular ETFs here to make way for these new Chinese ETFs in their portfolio. So they removed XLB, which is on basic materials, and XLY on large cap consumer companies. From what I can see is that their allocation of ETFs are very much diversified here, and I also really like to do this where I can show you in graphical form. So let me add that in for you. So we can see the allocation for Equity 100. QQQ is at 20.1% weightage, and we can also see that China companies MCHI is at 10.7% allocation and KWEB at 5.5%. You can do this if you like this sort of graph look, or you can just access it via their website, and they have a similar looking infographic. Let's come to the important juicy part of performance. In the graph here, you can see that there are some years that are very strong years, and what they've done is they've back tested for the years that the portfolio didn't exist to show us that performance. And we can see in 2020, it was quite a very strong performance at 23.1%. And 2020, we are at 3.8%. And on average for the last 10 years, they have performed 14.2%. So a very good portfolio performance, and hopefully over time they'll do even better. And that's what we always hope for when we are investing for the long term. Now let's look at core growth portfolio. Think of it as Equity 100 plus an allocation of bonds and an allocation of gold, because they essentially hold the same ETFs that are to do with the equity side, just that now they also have BNDX, the Vanguard Total International Bond Fund, TLT, Treasury Bond, IEF, 70-year Treasury Bond, AGG, US Aggregate Bond, and they also have GLD, which are the SPDR gold shares. What I can say is that this particular portfolio is a more balanced version. of equity 100 because you have these bond allocations, and that's going to translate in the performance as well, because these bonds and the gold ETFs are going to give you that sort of return that you can expect. And as you can see here, for the past 5 years on average, it has performed 13.2%, and that is a little bit lower than the 10-year average of equity 100 of 14.2%. This is completely expected. So I guess like the similarity between these two makes me want to lean more to investing with equity 100, just because I am that type of investor and I can take that sort of volatility where, let's say in March of 2020, I see my portfolio plummeting. I know that I'm not going to panic. I'm going to fit my investment portfolio to my personality and my investing strategy. So that's for me, but you really need to know what you are able to take in volatility and risk as well. So now let's look at REIT Plus. REIT Plus has been the thing that I've been very interested in, and as I said before, REIT Plus was the portfolio that actually drew me into looking into Syfe and investing with them. There are two portfolios here. One is 100% investing into REITs, and they also have a different option of REITs with risk management, where there is like a 50-50 split between the REITs and also bonds. So to name a couple of REITs that they hold in their portfolio, because there are just way too many, and you can access this information in the link below. There's CapitaLand Integrated Commercial Trust, there's Ascendas, there's Mapletree Commercial Trust, Industrial Trust, Logistics Trust, all Maple Trees, and there's Capel DC. Capel DC is Capel Data Centers, and this is a very popular REIT, and I didn't buy Capel DC in 2018, but they have performed very, very well. I didn't buy them at the time because I thought they were a little bit more expensive than what I wanted to pay for them. But regardless, they have performed very well. They also have Capel REIT, which is looking at the financial districts of Singapore. They have Frasers Logistics Industrial Trust and Frasers Centrepoint Trust and Suntec and many, many more. So what I did for this was I wanted to see what sectors in particular are they invested into for REIT Plus. And I've also used Google Sheets for this, so we can see they are actually invested mainly in industrial REITs. So at 39.53%, their allocation is emphasized in that. Retail is at 29.22%. Then they have a different bunch of REITs, which are diversified REITs, specialized REITs, office REITs, hotel and resorts, real estate, operating company, and healthcare REIT. So healthcare is very, very small at 0.82%. And we'll see how this fares over time. As usual, the allocation is for at this current point in time. Things will move and things will change as they re-optimize the portfolio. Let's look at the performance of REIT Plus. REIT Plus has actually on average for the last 8 years come up to 11.11%, which is not too bad actually. And what I can see here is 2020 was a down year for REIT Plus portfolio with Syfe, and I think that is one of the downsides of investing with a diversified REIT portfolio. When you are choosing the REITs for yourself, you're going to be able to decide what kind of sectors of exposure you want, and I guess that down year is mainly due to the relation with the pandemic and malls and office spaces not doing too well. And I see here they have some hotel and resorts hospitality type REITs, so those would have really pulled down the performance of the rest of the portfolio. So that is downside to investing in a portfolio like this, but the good years they did really well, like say in 2017 and 2019. So that's why our average over the last 8 years would be quite decent as well. Okay, so I think that's it. Now when it comes to investing in Syfe, I think very clearly I do like the Equity 100 portfolio and the REIT Plus portfolio. So I guess I'm gonna have a blend of both of them and invest into them. When it comes to fees, Syfe has actually quite an attractive fee of 0.65%. I think that's what is going to apply to me because I have less than 20,000 Sing dollars in my portfolio, I would imagine for now. If you have enjoyed this video and you would like to try out Syfe as well, I have a promo code for you, which is Suyin Ong. And by using this promo code, you're going to be able to enjoy up to 6 months waiver off of your management fees for up to 30,000 Sing dollars. So go ahead and use that if you are interested in signing up. And yeah, I guess that's it for the video today. I will see you in the next one. Bye!